Hello, hi everyone. Welcome. Thank you for joining us here at Block Live Asia. We'll wait for a few minutes before everyone else come in. Quick introduction of myself. I'm Jia Wen. I'm from Grounded. Grounded.Work is the company that is an organizer of Block Live Asia. Our website is www.grounded.work. We are a blockchain advisory firm working with some of the hottest projects in DeFi right now. So if you want to do a project in DeFi or you want to introduce your company to DeFi, email us at hello@grounded.work. We will read and reply to every single email. So I can see that the numbers are coming in. We'll probably start in a minute or so. So maybe, just to get everyone started, if you have any question, you can ask the question. You can also upvote the questions that you want answered from your fellow participants. And if we have some time, our speakers will choose a few questions to answer at the end. And without further ado, let's jump into the event. We are on a tight schedule. So our first speaker today is Adam Blumberg, co-founder of Interaxis. So Interaxis is a great educator in the DeFi space, and you can visit their YouTube channel anytime. I'll put it at the bottom of the channel. I am gonna bring Adam right on stage now. Adam, you'll be on in a few seconds. So while we are waiting for Adam to come on board, just to let you know, there will be 4 more speakers later today. And Adam is on. Hi Adam, over to you.
How are you?
All right, you can begin now.
All right. Can you see me okay?
You look great, Adam.
Thank you. Make sure. Okay, are you ready? Can you hear me? Yes, of course.
Yep, Adam, we could hear you great, and we see your whiteboard. You're good to
go.
Okay.
So we're going to talk a little bit about, to start this off, what DeFi is. And Lisa, I'm going to count on you to let me know if we have any questions, okay? Because I can't really read my screen from here. But we're going to talk a little bit about what DeFi is, because that's the purpose, I guess, of this entire session, this entire 2 hours you put it on. So let me know if we're good and you can hear me okay.
Adam, I think we can hear you better now. I can hear some background sound. Could you do a test? Say something to us.
Can you hear me?
Yes, I can.
All right. Now can you speak? Now we're good. Yes? All right, here we go. So we're going to talk real quickly about what DeFi is. And DeFi, of course, stands for decentralized finance. So the idea of something decentralized, of course, is to take out the centralization. So when we start thinking about decentralized, we have to go back to the origins of DeFi, of crypto, and of course that is Bitcoin. And the idea of Bitcoin is that this group of people wanted to give us a decentralized form of money, some form of money that would take us away from the banking system and take us away from the governments that controlled the value of money and controlled the transfer and the supply of money. Okay, so they gave us Bitcoin, and Bitcoin has been incredibly successful in giving us decentralized money. It gave us the ability, it gave those of us that connected to the network the ability to not only create it, but also to move it back and forth across the world. So Bitcoin gave us the first money, okay? And decentralized money was really important. This was the ethos, this was the idea of Bitcoin. But those that created it weren't sure it was going to work, and they weren't sure that it was going to be successful. And what happened was, it became incredibly successful. We can discuss, you can go back and forth and discuss whether or not the success was based on things like drugs and guns and all these other reasons that you might use Bitcoin to transact around the world. But the fact of the matter is, Bitcoin has been successful in this ability to transfer value, transfer money anywhere in the world at any time without having to ask anyone's permission. And that's what's so important about Bitcoin. Now, the problem with Bitcoin wasn't really programmable, okay? And of course, there's some debate about that. But you had decentralized money, decentralized value that can move back and forth around the world. But we didn't have the ability to actually program it and tell it what to do. So some of the geniuses that created, that are developers, programmers, and such said, we really like what Bitcoin has. We like the idea of money that we can move back and forth around the world, but we can make it better. How do we make it better? We have the ability to program money, program value. So decentralized finance essentially has given us the ability to take money, take this decentralized idea of money, and now add programmability. Okay, and the programmability is really important because now I can take certain functions of money and certain functions of value and scale them. Certain things that I could only do previously one-on-one, peer-to-peer with someone I know, I can now scale it. What's an example of that? In our videos, we talk about the ubiquitous Adam and Ron transactions, okay? If Adam has $100 and Ron needs to borrow $100, I can lend Ron the money. And we can do this because we have a level of trust between us, because I know him. I know he's probably going to pay me back the money. I can charge him some interest rate based on whatever is going on in my life and his life and the ability that I think he will have to repay this money. Now, of course, remember, I might give him a check. He might deposit that check in his bank. His bank is going to ask my bank, does Adam have the money? My bank's going to say, yes, Adam has the money. His bank says, okay, wire us the $100. We'll put it in Ron's account. This is all the traditional finance transaction that has to take place. The ability to have programmable money, decentralized money first, with the idea of Bitcoin, and now we've gone farther with Ethereum, and we've been able to say, okay, now we can program it and tell it what we want it to do. And now we can take this whole transaction. Bitcoin took this transaction and made it decentralized. Now, with DeFi, we're taking this transaction and making it decentralized. The ability to outsource this trust, this relationship, my giving Ron a loan and expecting him to pay me back is great, except it doesn't scale. It doesn't go on a national, worldwide level very easily, which is why in the past we've had to outsource that function. We've had to ask banks and governments to take on that function of taking this relationship and making it bigger. Okay, and we put that in the hands of banks, we put that in the hands of governments, we put that in the hands of other types of companies. And with the advent of decentralized finance and Ethereum and programmable money, now we can take this relationship and we can scale it and we can make it big. Because now all the atoms of the world can find all the Rons of the world, and we don't even have to know each other, and we can make this relationship encoded. We can encode it in a blockchain that is permanent, that is transparent, it's immutable, all these things, because now we can program money. So DeFi, if Bitcoin gave us a computer, okay, Bitcoin gave us, imagine one of those monster computers from the 1960s that can run like 2 functions, but it can just calculate things really fast. That's the equivalent of Bitcoin. DeFi has given us an operating system. It gives me the ability to go do something on my keyboard and have the computer completely create some other sort of function. Do something that I didn't have to program it to do it. It just knows how to do that. That's what DeFi has given us. It's the operating system for money. And once we have that, we can take little relationships like this and scale them. And talented programmers, talented developers are finding all sorts of ways that we can program money now. And one of the ways that we've seen is to program money, stable coins, right? So they figured out how to program money and say, we want you to equal $1. We want you to equal €1. Except that now, instead of it being $1 or a euro or a Bitcoin, it's something like a dime, okay? We want it to be, and how are we going to do that? We are going to program certain code to give people incentives to put money in and to give other people incentives to take money out. We're going to change interest rates, and we're going to make this scalable because of this ability to program. Okay, we are going to create things like loans, lending. Again, just like the example I had with Ron, once we can program this, we can take all the Adam-Ron relationships and make them bigger and say, what are we going to do? We want more people to borrow money. How do we give them the incentive to borrow money? We lower the interest rate, create demand. Okay, now we need money to give to people to borrow. What do? We increase this interest rate over here. More people will contribute money to this pool, and therefore we'll have more to lend. We're going to create demand, and this can all be programmable. Okay, we can have if-then statements. If the demand drops, lower the interest rate. If the demand goes up and there's too much supply, raise the interest rate. You can do that once it's programmable. And now we can take this code and say, okay, once I have the ability to earn interest on the money that I've contributed here, now what can I do? Oh, I can now send that money. I can send that token, in this case, to somebody else. And now they are earning the money that I was earning. And so you add this programmability to this unbelievable, what we call composability. Okay, and composability is the ability to build on top of each other. Okay, so you can have a stable coin that I can lend, which I can then send, which someone else can then use as collateral to borrow. Okay, and it all started with the same asset. The fact that it's now programmable and composable means that now the number of things I can do with my money is absolutely astounding. And what the developers are doing now to build on top of each other and to create an entire financial structure that is the way we would design it if we had to start now. It's not taking the old traditional finance and just barely building on top of each other. It's taking what we know of finance and what we know that we need and going, how would we build this now based on the way the world is and the internet is and such. So that is the basics of DeFi. The basics of DeFi are it's programmable money. It's the operating system of money. It's the equivalent of giving us a remote control now and saying, now you can go control the robot. You had the robot with Bitcoin, now you get the opportunity to control it. So with that, I'm going to stop and see what kind of questions we have. Anything? Lisa, do we have any questions? How am I doing on time? We're good? So I'll...
Adam, you have a question that's been upvoted 4 times. What are some of the risks concerning DeFi?
Some of the risks concerning DeFi. I know you're going to have people talking about risks later, so I won't get into them too much. But when you have anything that's programmable like this, okay, remember, think about when you're using your computer or using your phone, right? Every once in a while you get error messages. Okay, so you get some error message on your phone, you get some error message on your computer, and what can you do? You can just reboot, shut down, whatever it might be. Occasionally on your phone or your computer, you get viruses, right? And you have to, restart them. You have to occasionally use some sort of virus software or whatever. But imagine that with your money. Okay, so now you can get an error, you can get a virus, whatever, but it's on your money. And the problem is, if there's a hack, if there's an error, something like that with my bank, the problem with the bank is it's centralized. But the good part is that it's centralized. There's an 800 number I can call. If there's a problem with my decentralized, my programmable money, there's no 800 number to call. There's no one. So once my money is stolen from a particular application or protocol or whatever it might be, once it moves out of my wallet into someone else's wallet, there's really no way to recover. Okay, so that is the biggest risk. Some of these protocols are pretty new, haven't been tested. They're developed by people who are really talented, but haven't necessarily been around the financial world for a really long time. It's generally younger people, and they haven't really been around this world and seen what is out there. So that's probably the biggest risk, but I know you'll have people later talking about other risks. Okay, anything else?
Yeah, another question from the audience. Isn't it dangerous that DeFi is allowing anyone to play God in the monetary system?
Did anyone do what?
Play God in the monetary system.
It can get dangerous. Protocols to get released on the Ethereum blockchain or any of these other blockchains. Anyone can go release them. It's up to us to, one, do our homework, to try to make sure that if I'm going to put my money, if I'm going to put my funds, my assets, my ETH or anything else inside of any sort of protocol or any sort of product like that, that I make sure that it's audited, that I make sure that I'm not putting everything I can in there. You can play all sorts of games that you want within the operating system, within Ethereum, but that doesn't mean that other people are going to put their money in. Okay, so it is more incumbent on those that are investing or those that are lending or those that are using the system. It is more incumbent on us to take care of it, to secure our own money, to secure our own funds, because we've been so used to letting the banks and the investment companies handle that and knowing that if there's a problem, I can call them. Well, now I don't have that anymore. So anyone can go throw out code on Ethereum, and I just have to be vigilant and say, maybe I'm not going to put my money there because I haven't tested it, or maybe I'm going to try it out with $50 first and see what happens for a while. Okay, so it's now incumbent on us to be much more vigilant and make sure that we are keeping our own money safe. Is that good? Is my time up?
Yeah, I think our time is up now. I heard from the audience that there is a lot of frequency when two speakers speak at the same time. So Adam, I've muted you for now. Thank you very much for giving us your time. Guys, Adam's Twitter account is below. Please follow him on Twitter. You can tweet him your questions. I see that there are still a few questions unanswered. I'm sure Adam will be very happy to have that conversation with you guys on Twitter. He has YouTube account too. I'll put the link up. Thank you, Adam, for your sharing today. Really appreciate it. And next up, we have DeFi Dude. So DeFi Dude is a community manager at Aave, one of the front runners in the DeFi space. He is also tweeting on Twitter at DeFi Dude. I'm going to put up his Twitter link below while he's speaking, so you guys can follow him at any time. His topic right now is a very important one. I think we should be discussing all of this. We all know that DeFi is growing very quickly and everybody's jumping in, but what are the downside and what are the risks? So without further ado, I'll be bringing DeFi Dude up on stage.
Hello. Yeah, I just wanted to hop on and say it is DeFi Dad first. So if he doesn't mind, I'm more than happy to share right now. I don't know if DeFi Dad is available. Yeah, let's have him jump on.
Hey everyone, can you hear me okay? Let's see here. It's so funny because I've talked to, oh, there we go. We're all good to go. I've talked to DeFi Dude so much and I've actually never seen him in person. I don't think he's ever seen me in person either. So, hey, by the way, sorry, I've got like a mattress in the background. We just moved and we moved across the country, so our house is a mess. But what does it matter? That's kind of how DeFi is. It's a little bit messy right now. Cool. Well, Lisa, thanks for putting this together. Thanks for having me. Really appreciate it. And Adam, great job. All the speakers here are actually wonderful, so I hope you stay the whole time. I'm going to talk to you today about how to get started with yield farming. And I think it's really important to watch this to the end because I cover the risks of yield farming. And then also pay close attention to everyone speaking after me, including what Adam just covered, because I think it's good to understand those fundamentals, that you're not diving into something without fully understanding it. So let's go ahead and share my screen. Give me just a sec here. Here we go. And, oh, actually, where did that go? Oh, there we go. Now I see it. All right. Let's share the application window. There we go. Okay. I'm going to just double check the chat once more because I've given like a 15-minute presentation once and I wasn't sharing my screen. So let me know if you can see my screen. Good. Okay. Excellent. Thank you. All right. So I'm going to hop back and forth between some slides and actual live examples in my portfolio. So Here we go. All right. So anyways, yeah, so we'll talk all about yield farming today. Just a quick background in case you don't follow me or you've never watched any of my DeFi tutorials. I have been in the Ethereum space for about 3 years. I've been obsessed with DeFi for about a year. Kind of fell in love with it last summer because I recognized compound and token sets were really starting to become more exciting. There was more liquidity there. And so it was just unreal to me when I realized that Compound had 50 million in total value locked, while Maker had about 500 million. So Maker had always been this big behemoth in the room, and it was mind-blowing to me that someone was starting to catch up. And so it seems so long ago, but a year ago, that was a huge deal that another team was gaining that sort of traction. So anyways, I started making Twitter tutorials just because in my spare time outside of like my day job, I thought it would be fun to demonstrate that DeFi is actually really easy to use and sort of counter the narrative out there that Ethereum needed a better UX. So anyways, I post all these videos now at DeFiDad.com, which just reroutes you to my YouTube page. Also follow me at DeFi_Dad on Twitter. What's really cool is this week I'm actually joining the Zapper team, and coincidentally, Zapper plays into a lot of what I'm going to talk about. It's also one of the most important DeFi tools that I use daily. It's a tool that I use to monitor my portfolio, and I also use it to invest in different DeFi opportunities because it allows me to do that in just a few clicks. So we'll talk more about this here, but this is just a quick example of a Zapper dashboard. So if you're in DeFi, one of the nightmares is that there's so many applications and there's so much happening and there's so many tokens that it would be impossible to keep track of. And I've sort of lived through this myself. Like I've lived through the pain of wondering where all my money is and keeping open a million tabs and like trying to track it in a trading journal. So what's really cool is Zapper lets you just connect your wallet and then it lets you visualize everything that's there. So we'll talk a little bit more about that in a bit. It all kind of relates back to these tools needed for yield farming. So here's what we'll cover, and I'm going to try to breeze through this because I want to make sure we end in 12 minutes so the next person can start on time. So we'll talk about recognizing what is a yield farming opportunity, what are the common tools to get you started, what are a few examples, and then what are the risks to consider. So here we go. By the way, I'm going to pause just a moment, check the chat, make sure, is everybody good? Everyone can see me still. Is my mic okay? Everything's okay. Good, good. No echo or anything like that. Yeah, looks like it. No feedback. Yeah, okay, good. Sorry, just double checking. Okay. Again, I have like PTSD from this presentation. I gave like a 15-minute presentation and I found out 15 minutes in that I had just been like a blank screen the whole time. Okay, let's go back to, here we go. Okay, so what's yield farming? It's actually really easy to define, and for some reason, yield farming has been this really confusing topic in crypto. I think it's mostly the Bitcoiners that have a tough time following anything other than the orange coin number going up. But this is what yield farming is. It involves providing liquidity. It can also mean that you are lending. And then it only requires an Ethereum wallet like MetaMask. So it shouldn't require any KYC. And the last sort of qualifier for this is that it involves, well, I guess aside from using DeFi protocols on Ethereum, and we will see more applications in the future, and there are some out there that are not on Ethereum, but for right now, the majority are on Ethereum. Aside from that, it involves earning multiple forms of yield. So those multiple forms of returns are lending interest, trading or market making fees, basically what you earn in something like a Uniswap for putting your liquidity into the pool. And then the last thing is just what I call pooled rewards. A good example of that is a governance token. If I participate in a yield farming program and I lend my money or my liquidity, I am earning a share of that network, or I'm earning a voice in the future of the network through the form of a governance token. It's basically like a customer acquisition cost, but it's so much better because you're creating loyalty for folks to participate in your ecosystem, in your application, by giving them a voice in the future upgrades and proposals to the protocol. So it just means I have voting rights. Now, aside from that, I'm not going to not acknowledge that governance tokens have a value, but it goes beyond what's happening within the confines of the DeFi protocol or application. It's because of the fact that we can trade permissionlessly on tools like Uniswap. No one can stop me from putting my governance tokens onto Uniswap and then allowing buyers and sellers to battle each other for what the price is. So at the end of the day, teams in DeFi right now are, I would argue, are more focused on creating loyalty and creating an active participating community using their application. However, these governance tokens can be traded on exchanges like, and I mean decentralized exchanges like Uniswap or Balancer. And so that anyways comes with a certain monetary value. All right, so next up, beyond what is yield farming, here's the common tools to get started. There is lots more that we could talk about, but these are the most obvious ones. So to explore, I need MetaMask. There is no way to get around using MetaMask. You absolutely need it. You can use other wallets like Wallet Connect compatible wallets. It's a wallet like Argent, where I just scan a QR code on my computer, and then I am able to connect my mobile wallet on my phone to what's on the screen. But I would highly recommend MetaMask. It is one of the best and most secure wallets, and the user experience keeps getting better. Then there's monitoring my DeFi assets and my liabilities. That's through Zapper and Zerion. Zerion.io is another wonderful tool. They do really great work. And so these are really the two dominant tools. I'm trying to think of also, there is, I'm forgetting one more, DBank. Go DBank, I think it's DEBANK.com. It might be .io, but DBank is also another one. Sorry, I forgot them. Then next up, to participate, these are the tools that I'm going to sort of talk about here for the next few minutes. Zapper allows me to invest in all the different liquidity providing opportunities in a few clicks. And then there's the actual applications that we're using, because Zapper is just opening the door for me, is Uniswap, Balancer, Curve, which is a stable coin. It's a series of stablecoin pools, and it also allows me to trade between tokenized Bitcoins. And then the last part of that is Yearn.finance, which is just an outrageous protocol that's like fully dedicated to automating the most like sophisticated DeFi transformations. So this Yearn.finance is one you need to follow, because they basically will take multiple steps that someone like I would be aware of in order to earn returns, and they automate it by letting you just deposit, let's say, stable coins, and then doing all the magic that someone like me would have done manually. They automate it, and they make DeFi really easy for folks to use. Last thing is just staying informed. Part of the hardest challenge to being in DeFi is staying informed and updated. So that comes with following Adam, who just spoke at Interaxis on Twitter. Follow me, follow everyone else here, follow Lisa. You should subscribe to the Defiant. You should subscribe to Bankless. You should watch Bankless YouTube. You should check out yieldfarming.info. This is an incredible free website that you can check out all sorts of opportunities there. And then this last one here is a tool that it lets you look up all of the different pools in Balancer by asset type and by returns. So it'll estimate what sort of returns are being earned there according to how much money you put into the pool, which makes life really easy. So those are some of the common tools. And then let's go ahead and talk through a few examples. I'm going to check the chat one more time to make sure I'm still live, all good. Okay, nobody's complaining. Oh, yeah, I love that what Lisa just said about the codify and automate all the nerdy business logics for regular people like you and me. Yeah, that is so true. That's a great description for Yearn. Okay, so the first example, I think one of the easiest examples in yield farming, because again, the goal here is for me to be using decentralized applications. I'm not submitting to any KYC. I'm using an Ethereum wallet. And again, not to exclude, like we will see applications being built, and there are some built that are not on Ethereum, but majority are still there on Ethereum. When we look at the Curve pool, Curve, let's go check this out a sec. Here we go. Curve provides a utility that is very, very, very valuable that did not exist previously, or at least it didn't exist in the way that we would hope it would. They allow me to trade between stable coins. And let me just scroll down here. Here we go. So they allow me to trade between DAI, USDC, Tether, and True USD, and the Binance USD dollar, and the Synthetics SUSD. So these are stable coins that are really popular, and for one reason or another, like you can run through them, they all have their pros and cons. I prefer SUSD and DAI, and Tether. Actually, I still use Tether, even though it's like it's the one that has the most baggage, I guess. But anyways, I use all of these, and I can trade in between them. And previous to Curve, there weren't really great exchange rates on DEXs. They would fluctuate a lot, and they've done a great job of providing more liquidity and enabling these to come to equal a one-to-one sort of pairing more closely. So anyways, that's the utility. So if we go back to this, if I want to participate in this application, I can just deposit my stable coins. So I could deposit 334 DAI, and if I do that, I am now earning a portion of the 0.04% trading fees. So that's the first form of yield. The second form of yield is that you don't need to like fully understand this, but just know that the magic behind the scenes of this is that when I deposit my stable coins, they're actually being wrapped into a token that is being lent across different DeFi lending pools by Yearn.Finance's protocol. So all you need to know is that when I drop my stable coins into Curve, I'm earning lending interest thanks to this like automated magic, thanks to Yearn. And then I'm also earning the trading fees from Curve. So there's two forms of yield there. The third form of yield comes into play because there are, actually, let's go back to our list. We covered lending interest, and we covered trading fees. The third form is a pooled token, or like a reward that the protocol provides. So Curve just decentralized into a DAO, and now they are trying to provide all of us with tokens to continue to participate and to have a voice in voting on future upgrades to Curve. So anyways, long story short, I can come here. When I am here, I deposit my stable coins, and they give me an IOU. Like I mean it as in the layman's terms, IOU token. It's called a liquidity provider token. It's a Y Curve token. I take the IOU token and I deposit it here. I do that because that allows Curve to know that this wallet is providing liquidity, and here's how much, and thus we owe them a voice in the future of our protocol. So here are however many of our Curve CRV governance tokens. So long story short, I should use Zapper. I should go to invest. I look up the Y Curve pool. Here we go. I look up the Y Curve pool. Here we go. Oh, it's actually right there conveniently. Here it is. I look up this pool, and then I can just add, oh my gosh, computer, you are so slow today. Here we go. And I can add liquidity. So I was just showing you the multiple applications there, but I could just go here and I could actually just add my DAI and zap it in. And now I'm a liquidity provider. And then the final step of that, which I cover in a tutorial that is at DeFiDad.com, I go here as the final step and I stake the YLP token or deposit. If you ever hear stake, it just means deposit. It's just a word that gets used in DeFi. So I'm earning 3 forms of yield for just providing stable coins. And this is why yield farming is so addictive. This is why yield farming is so exciting. There are all these different ways for me to earn passive income. And that passive income is like passive income on steroids because there's all these new opportunities. And I would argue that most of the world doesn't know about it yet. Okay, so I'm gonna skip I know I'm running low on time or I'm about to run over. So we covered the main example here of earning 3 forms of yield. The only other one I just wanted to briefly touch on is I have the ability to automate even more of like how I'm earning those returns. So earlier, I deposited stable coins into Curve that was earning me interest and trading fees. However, instead of me having to go to the Curve DAO and stake or deposit the Curve YLP token, I can instead go to Yearn.finance. So this is another yield farming tool that you got to check out because they enable you to deposit tokens like the Wi-Fi token or DAI or USDC, or they let you deposit the Curve YLP token. So I'm earning lending interest, I'm earning trading fees because I'm in Curve, but then I'm taking that LP token, I'm depositing it here, and at this point in time, according to the market numbers, I'm earning about 90% ROI, and that's based in US dollars, it's annualized. The numbers fluctuate daily, but this has held above 90% for a few weeks now. It's magic. I mean, I can drop it in, and the magic is that a team that is very smart, that could have clearly just continued to do all of this on their own and made humongous returns and did not have to share any of this detailed information with us, I think was smart enough to code it into their protocol, and they're automating all of it for me. So now I'm just depositing my liquidity, and I'm earning additional returns from that. So that's that was the other example there. Just another way for me to earn on top of the 10 to 60% on average that I see in the Curve Y pool. This adds another 90%, which is like an outrageous number. And like really it could go away. In the next month, we could see it drop to 50% and down to 20% or whatever. But like, who cares? Like my bank pays 0.01% right now. So, these are outrageous numbers, and this is all possible because this is peer-to-peer finance and we don't have the middlemen that we have to pay. So last thing I just want to cover very quickly, because I need to hop off, is risks to consider. I cover these in every single DeFi video. I know Adam from Interaxis is really good about covering these as well. I think as a community, we have to continually remind each other, like, if you're telling someone about an opportunity, you should be thinking about the many risks here that continue to show up in every DeFi application, or show up in quite a few of them, so that we're mindful of them and we're thinking about how to mitigate that risk. Number one, in every DeFi application, you have smart contract risk. That means there could be a bug, and that bug could mean that all of the funds could be drained out of it. That's like the doomsday scenario. When you yield farm, you're using multiple protocols, or throw out the word protocol. You're using multiple applications, and those applications are being stacked on top of each other. Well, while the returns are being stacked, and that's the most wonderful thing in the world, and everyone loves to see more money, you're also stacking risk. So it means that like I'm really adding risk to my exposure to all these different DeFi applications because I'm using them all at once. The other thing to be aware of, which I don't run into as much because I tend to use the more premier names in DeFi, and I'm very careful about the newer stuff that I dabble in, even though like that's kind of what makes DeFi interesting, is that anybody can launch anything and they don't have to ask permission. I'm just always thinking about scammers. what if someone launches an application and holds on to the admin key? In other words, what if someone launches it, says it's decentralized, but really they've maintained administrative control from, like, think of it like from the back end, and now you're depositing money into something that they can just, you know, they can withdraw themselves and walk away with all the money. This is gonna happen eventually. And it really, I think we've been lucky so far it hasn't. It's gonna happen. You should be questioning every time a new DeFi app comes out, how do I know that I can trust them? You know, like, is there a verifiable team identity? You know, like, are there, I hate to put this on me, but like, this is my worst nightmare. I think about, what if I start using an app and I've posted about it and people trust now that that application is safe to use because they saw it on my YouTube page. So anyways, this is one of the scarier things. The other thing is, I'm gonna skip governance compromise, but it's just referring to, like, what happens if someone gains too much control and voting rights? They could technically vote against the best interests of the community. But then again, why would you do that? Because if they're holding the token, they want it to go up in value. And if you're voting against the interests of the community, like, wouldn't the token go down in value? Impermanent loss, this refers to if I'm holding liquidity in, like, Uniswap, if I go into a pool at a certain price and the price skyrockets or drops in value, the ratio of the amount of tokens I have is going to change. And that could be good or bad depending on what my strategy is. Google impermanent loss, it's a really important term to understand. Last few things, stable coins or tokenized Bitcoins, those can depeg. So they haven't. I mean, they've continued to always hold within, I think, a reasonable range, but DAI has traded at nearly a 10% premium. We've seen other tokens fall well below the dollar. We all worry about the black swan event. Like, what happens if, like, the world melts down and I'm holding these assets and they become worth half as much value? And then the last thing is just sort of a general warning. Everything in DeFi is interconnected. If you look at the way Curve works and the Yearn finance protocol, and you look at all the liquidity in Uniswap and other protocols, it's nuts. So like, it's nuts because it all, like, works together in this beautiful sort of symbiotic harmony. Just be aware of that like, there is a lot of risk in this. And so I think it's important to think about how much money could I lose due to something completely unforeseen, not even like a human error of, like, losing your wallet or losing access to a private key. What if something happens totally out of your control? Could you continue on with your life? That's how I think about it, and that's how I limit my exposure. So anyways, thanks so much for letting me present. And Lisa, I am so sorry for going way over, but I hope this was helpful. And yeah, follow me at DeFi_Dad. Also check out the very top page.
Thank you, DeFi Dad. I'll be bringing on our next speaker since we are running out of time. So next up, we have Sebastian Aldaroso, who is a member at Concourse Open and a contributor at Defiant, at the Defiant. I'm bringing you up right now. And meanwhile, DeFi Dad, if you are listening, we had a lot of questions coming for you. You know, feel free to take it on Twitter or later on in the chat. Sebastian, over to you.
Hello, everyone. Can you hear me on the other end? Cool. Excellent. Okay. So, well, first of all, thanks so much, Lisa and Joanne, for the invitation, for putting this up. I think it's super interesting. I'm really happy to be here. I think that the previous speakers, both Adam, DeFi Dad, they were great. So I would definitely, follow them on Twitter, follow all the work that they do, because they are really good, both of them. So I will have a slightly different focus today on my talk. It's what you're missing on DeFi. So I will start taking my time. So basically, I will try to speak about DeFi in a high level. So I will not go a lot into the details. So if you give me a sec, I will go ahead and share my screen. Just a minute, please. Okay. Okay, perfect. Okay, so can you still hear me? Is everything cool? So I can put the whole screen? Yep. Sounds great. Okay, cool. Okay, so what is that you're missing on DeFi? My perspective is that if you're not looking into DeFi, you're missing on one of the most vibrant and innovative industries on Earth, which is growing at an exponential rate, and where a lot of experimentation, not only at the technological level, but also at the social level, at the economic, financial levels is happening. There's a lot of innovation going on, a lot of growth going on, and a lot of interest, really interesting outcomes that we're seeing. So the first thing that you've been missing is exponential growth of a highly innovative industry. Here are some numbers that I want to share with you. In the past 6 months alone, DeFi has grown for more than 10x. This is the total value locked metric that we use at, well, the whole industry uses it, but it's a DeFi Pulse metric that basically states how much money is locked in the smart contracts of the DeFi platforms, DeFi protocols. If you check out on the left, you'll see that in April, we were at like $682 million in the whole DeFi. Now it's like, 5 months after, and we're at almost $8 billion in the whole industry market. So, in the whole DeFi market. So what we're witnessing is that there's really an exponential growth going on. What DeFi Dad, I think, said, like, he had started, being interested in DeFi 1 year ago because there wasn't much before that. And now in a few months, throughout 2020, the growth has been outstanding, and it keeps on growing. The almost 700 million figure that you see on the left, nowadays, that is the growth that we are having weekly. So every week we are adding like 700 or 800 million dollars to value locked on DeFi. Well, this is of course this is joined by a lot of innovative new projects and protocols that are being launched in a weekly basis. There are many of these here, but I'm just sharing a few of the many different protocols and DeFi products that are launching week after week. Yearn Finance is one of the ones that DeFi Dad mentioned, which is basically, you could think about Yearn Finance like a money robot that basically seeks the best opportunities for you in a like automated way. Balancer is pretty similar. Well, it is a decentralized exchange, similar to Uniswap. It has some differences, but basically it has the same approach of having liquidity pools and providing those liquidity pools so users can interact against them and trade different assets. We have Perpetual Protocol, we have Unstable, and we have many other projects that launch weekly, that launch with excellent teams, excellent products, and really innovative from the technological aspect, and also from the social experimental aspect, which we will dive in a couple of minutes. This is another screen that I wanted to share with you to think about the exponential growth. It's kind of related with this one previously here. So if we check this one out, total value log has grown more than 10x. There are many new projects that are launching on a weekly basis, high quality teams, high quality products, and which are really and many of these are real breakthroughs from the technological standpoint. If we take a look at this screen, here we are looking at the DeFi Pulse leaderboard. So these are all like the leaderboard of the DeFi protocols. If we check out in April, we have like 24 on the leaderboard. Now in August, a few months afterwards, we have so many that it doesn't even fit on my screen now. So the growth has really been amazing, and this is something that it continues to happen week after week. It's becoming, even for the most DeFi head users, it's becoming increasingly difficult to be able to be on top on everything that is happening. And I think DeFi Dad and Adam both mentioned that this since these are trustless or decentralized protocols, one of the magic things about them, it's not really magic, but one of the great things about all of these projects and protocols is that they are interconnected, so they are transferring value among them. So if we have when new projects and protocols get on board in DeFi and add value, that automatically can be transferred with the others and interacting with the others, and in that way we get like stronger network effects, which is basically adding more value to the user. As more users get into the network provides more value to the user, and the user also provides value to the network, which also happens, of course, when new projects and protocols come in. So, second thing that I thought I was interesting, I will do the same thing that DeFi Dad did to make sure that. Can you still hear me okay on the other end? If you can say yes on the chat. Yep, okay, cool. Thank you. Okay, so this, maybe I'm exaggerating this a little bit, but I think that we are starting to see some signs or some signs that DeFi is starting to kind of cross the chasm or the chasm. I'm not sure if you say chasm or chasm, but which is a really important metric in technology. The chasm chart that you can see here is by Jeffrey Moore. He's an author. He has this book, Crossing the Chasm, which is really interesting. I recommend it if you haven't read it. And he basically shows the different market instances that every technological product goes through until they reach maturity and until they reach the mainstream users. So if you see here, the early market are the innovators and the early adopters, and then we go to the early majority, late majority, and so on. So DeFi, Ethereum and DeFi are still at the early market phase of the technological adoption. So I would say that we are at the early adopter phase, not innovator phase. So more adoption now, but we are starting to see some little things that are making me think that maybe DeFi is becoming ready to get into that early majority. So starting to cross this chasm and become unstoppable, basically. So there are a couple of things that I want to share with you that I think are going towards that crossing. So here's an example by Uniswap. Uniswap is a decentralized exchange. They have about $2 billion weekly volume, and about 530, 600 on some days, I think, daily volume. which is it's really a lot if you think about it. This is code that lives on the Ethereum network, and that you can interact with it trustlessly. That means without any intermediary, without any middleman. And 2 days ago, Uniswap, for the first time, had more trading volume than Coinbase. Coinbase, as you know, is it's a US-based exchange, which is it's a crypto exchange for sure. But it is a company that it's centralized, so it works in a different way than all this set of protocols. And they have more funding. They have larger teams. They work directly with regulators, so they are really different. Like you could think of, I don't know, Coinbase or at least I think of Coinbase like a Google or like a JP Morgan but a crypto bank. So basically, they have more resources, they have larger teams, and Uniswap is making more daily volume than what they are doing. I mean, they surpassed the volume once, but this is a sign, I think, that really DeFi protocols, DeFi products and services are starting to, touch the early majority and touch these other, more mainstream products and mainstream users and say, hey, we are here. Another example, this is like really, really new. Aave. Aave is like money markets protocol, similar to Compound, but that's just saying that would be wouldn't be fair about Aave, because they are continuously innovating and adding new products and services to their DeFi platform. But I don't want to dive a lot into Aave at the moment. What I just want to share with you about them is that last week they announced that they now have they were approved in the UK to be an authorized electronic money institution, which is huge, I think, for DeFi, because this means that Aave will now start bridging, so tending a bridge between traditional finance and DeFi. Basically, consumers and businesses will now be able to, through Aave, get access to payments, to currency conversions, and Aave will also be able to issue electronic money accounts for both consumers and businesses. So I think this is huge, because just like we were seeing with Uniswap, like starting to eat the volume of the centralized exchanges, being a trustless protocol. Aave being a trustless protocol, and with all the different products that they offer, getting this license and starting to connect the DeFi with the, let's call it real world or traditional finance, which is huge. So I think that, like we were mentioning, DeFi is, or there are some signs that it's starting to cross this chasm between early adopters and the early majority. Well, and to finish, and this will overlap a bit with DeFi Dad's talk about yield farming, but I'll go back just a sec. So what you're missing on DeFi, I think one of the most vibrant and innovative industries on earth, which has exponential growth, which is showing signs that it is starting to cross the chasm, and where we have amazingly interesting social experiments in capital and power distribution that are being held today. So I want to touch a little bit on this. DeFi Dad also touch on this, so I'll just touch it a little bit. Here on the left, you can see Yearn Finance, Compound, Balancer, but there are many others. I just selected those three, no reason, just select those three. But basically, when we're saying about social experiments in capital and power distribution, what I mean is through governance tokens, which all of these platforms issue. Each of these protocols have they have their own governance token, and basically through governance tokens, what you get to do if the distribution of tokens is fair, because you have different protocols, you have different products, and sometimes this distribution is fair and sometimes it is not. But if it is fair, if the system is done in a way that seeks to distribute power, distribute decision-making power among the community, this gets really interesting because it really distributes the ownership of the protocol among users of that protocol, and mostly via liquidity incentives, which DeFi Dad told about. So what I mean mainly via liquidity incentives is you can, by providing liquidity to these systems, you can obtain governance tokens in exchange as a reward for that. You can also buy them in different exchanges like Uniswap, Balancer, and others. But the idea is through governance tokens provided by these platforms, they distribute ownership of the protocol among users of that protocol. So users have the right to vote. They have the right to propose changes to these protocols. So it's very different when you think it like when you compare it with like mainstream companies like, I don't know, GAFA, like Google, Apple, all of these companies where you can you don't have the access to from the starting moment or the starting. The difference between those big companies and decentralized protocols that provide governance tokens to distribute the ownership on the platform is that you can do this from scratch and anyone can do it around the world. And the only thing you need is some capital, and you need a wallet, and that's it. Basically, you can start being a participant in the governance of Compound Year Finance or Balancer or any other of these protocols that distribute governance tokens. So I think that is really, really powerful. And the last thing that I won't get a lot into this because DeFi Dad spoke a lot about this, but yield farming, which is I use this like sentence to define it, is the act of leveraging different DeFi protocols and products to earn a yield or a return on their assets through a combination of lending interest and token incentives. I wanted to mention this because when we were thinking about social experiments in capital and power distribution, we have all the, like we were speaking, like I was mentioning, the governance tokens that provide you ownership over these protocols and allow you to participate in the decision making and making changes to these protocols and the way they work. And yield farming is the initial way by which these protocols are distributed, which is basically you add liquidity to these protocols and you get these tokens in exchange. And one of the important things I think of yield farming, even though like today the APYs are like 100% or sometimes more, so we don't know if those will last, but yield farming was one of the distribution mechanisms that helped a lot, and I'm going up a bit for this change in the total value locked on DeFi. So in April, liquidity incentives, yield farming did not exist yet. So it started like with, I mean, it existed in the past, but not as we know it today. It began with comps from Compound. So yield farming was one of the main reasons why this is growing a lot. So distribution of governance tokens among the community. And that's all I got today. So 19 minutes. Thank you. If you have any question, happy to answer. I don't know if we still have time or not.
Thank you, Sebastian, for the sharing. And guys, if you guys like what you guys Sebastian shared, you guys can also follow him on the Defiant. So that's the defiant.substack.com. He is also on Twitter. So next up, DeFi Dad. I'll be bringing you on right now. Okay, I think DeFi Dad is offline right now. Lisa, do you mind going on next? Oh, okay, DeFi Dude. Sorry guys. Let me bring DeFi Dude on. Alright guys, everything should be all sorted out now. DeFi Dude is coming on. 3, 2, 1.
Hi. Yeah. Sorry. I get confused for DeFi Dad quite a lot, so no worries there. Hello, everyone. I am DeFi Dude. I do community management over at Aave. Today, I'm going to be doing a quick presentation just about all the risks in DeFi. There's a lot going on in DeFi right now, a lot of craze. And with it, obviously a lot of risks. So I'm going to go ahead and share my screen quickly. Okay, can you guys see my screen okay and hear me? Cool. Okay, so we have the dark side of DeFi. We're going to be covering a lot of the risks, as I mentioned today. There's a lot going on in DeFi right now, and there's a lot of really awesome stuff as well. Obviously, my name is DeFi Dude, so I'm a huge DeFi advocate. From the start, I got into DeFi. I would say really big, probably around the summer of last year. I think right around when DeFi Dad got into DeFi. It's kind of been interesting to watch it evolve. It's evolved kind of from, this new form of finance that is kind of like, it's very innovative, and we're all, kind of here to watch it develop. But then in the past few months, or at least a couple months, it feels like it's almost taken a turn from what we were kind of originally seeing, and now it's more, like, let's get a bunch of cash. How can we yield farm this, that, and some of these have value, but lately I feel like it's some of that value that it had early on has been leaking away, I think, but there's still a lot more coming, and it's only been getting bigger and bigger. So definitely happy to see it and watch it live. So what does risk in DeFi mean? This little chart here in the middle here, you've got crypto and Ethereum, right? So there is inherent risk with just using crypto and Ethereum. I mean, let's say we've got like seed phrases, private keys. I don't even have my own parents manage their seed phrase because they, it's very hard to relay the message of like, okay, these 12 words or these 24 words, this is your master password. There's no username. You can't change your password. You can't just change your seed phrase. You quite literally, would have to get a whole new account or wallet in that case, back it up, move everything over. So, so there's risk alone in securing your own wallet, backing it up, making sure no one can find it. You've got volatility as well. Obviously crypto is very volatile, so that's a risk in itself. And things like that, centralized exchanges being hacked, those types of things. But then you have the smart contract risks or DeFi risks in general. And now I kind of separate these between DeFi and DeGen-Fi, as I like to call it, which is kind of what I would refer to as like the more recent DeFi as DeGen-Fi. But going back, the smart contracts and regular DeFi, I guess I would kind of group those together for risks. So where the risk comes from that, a lot of it is to do with, there's two big ones, which I'm going to touch on later, but it would be, regular smart contract exploits, as we saw back in 2017, 2018. A good example is the parity multi-sig exploit. We had over $100 million in Ether just sitting in the multi-sig. And then some guy comes along and he's like, hey, your code is vulnerable here. You should do something about it. And then, 10 minutes later, oops, I killed it. And, then the contract is destroyed and, $100 million or whatever is just locked in there forever and ever and ever. So that, is one example of an exploit, except in that case, the hacker didn't get to steal the funds, just lock them. So you've got things like that. And then you've got like admin keys, whereas, for example, if a contract has an admin key, it could be set up in many different ways. But the general idea of an admin key is basically, okay, so you have a wallet, we're going to give this wallet, admin, permissions to this contract, which a lot of times could mean, this owner could drain all the funds out of this contract. So as an example, let's assume Uniswap had an admin key. It does not, but let's just assume it had like a master admin key that, what would that mean? The admin key could potentially like drain all the liquidity on Uniswap if it was set up to do that. So like the admin key could be specifically laid out to, maybe only adjust the network fee, and maybe it has no permission to even touch liquidity. So, it's just something you'd have to properly research first. And again, I can get more into admin keys as we go further into this. But then we've got the DeGen risks. And, I guess the DeGen and DeFi risks, I would say they do kind of blend in with each other. There are a lot of shared risks between the two. But I would say that DeGen in general kind of has more of the like experimental risks as well, on top of like, admin keys and stuff like that. It's got risks that are more like, it's hard without a specific use case or like a specific example, but more specific to like that token, I guess, and their unique experiment, whatever they're running. Again, I don't know how to word it exactly, but I can touch on this in a little bit here. So let's see. Is DeFi inherently risky, more than other Ethereum applications? I've seen a lot of people on Twitter recently, they kind of disregarded DeFi or kind of discredited it altogether just because of like the recent sushi farming and that sort of stuff. And it was kind of like upsetting, I guess, to see. I know one person that I'm really thinking of, they're known in Ethereum, they've been around. So to see them kind of like discredit DeFi as a whole and kind of say, hey, it's not going to go anywhere. This is all just kind of fun and games for now, and it'll blow up and that won't matter. I'm not really a fan of that. I don't really get where they're coming from for there. I don't think it's, inherently more risky than other Ethereum applications or dApps. I think a lot of it has to do with, these test and prod, unaudited code contracts sort of things. Like obviously these are going to be more risky because they're unaudited or they're very new or, they've never touched a test net. So of course those are going to be more risky than other stuff. But, the act of saying DeFi itself is more risky, it really isn't. It makes no sense just because there's a contract that has to do with decentralized finance. It doesn't really add that much risk. I think it's really just where people that are building in DeFi are kind of going right now with their risks. I feel like so a lot of these people building on DeFi are by choice, releasing it with little audits or things like that. And so obviously there's more risk, and I think people are attributing that to DeFi as a whole, which is not. I mean, there's much more to DeFi than just farming yams and shrimp and pasta. And another thing too is, so as we saw from Sebastian's DeFi Pulse metrics, there's over 7.75 billion locked in DeFi, which that is a lot, and it's grown like crazy, very awesome to see. And there's only been less than 100 million lost in DeFi. So I put a little asterisk there because this number, I could not track anything down. I looked at DeFi primes for 2020, how much was lost. I think it was like less than 30 million. So I just said, okay, screw it, I'll throw on some, an extra 70 million, whatever. call it a day. So I don't know exactly how much is lost in 2020, but like the amount that's been lost for how much is being, risked or put up, it's kind of incredible for how much everyone's yelling how risky this all is, just for, how much is lost compared to what we were losing in like 2017, 2018, just to centralized exchanges. We lost so much money. And I guess, people were yelling risks then, but now it's like people are still screaming risks about this DeFi stuff. And yet we're still not seeing a whole lot of losses in terms of like catastrophic failure type things, or, but that's not to say we won't. I mean, cross our fingers there. So how do we warn people about this risk properly? You've got kind of two sides of people, I think, that I've seen. You've got the people who are screaming at the top of their lungs, hey, this is risky, don't do this. And then you've also got the people who are like, all right, well, maybe there's high risk, high reward. So it's kind of a double-edged sword, right? Those people who are screaming, well, hey, there's super high risk, you'll probably lose your money to this. They obviously think they're doing a great service, and sometimes they are, by letting people know about these risks. But at the same time, and this is actually like, I thought of this, my buddy Cooper Turley, who does a lot of great stuff in governance and DeFi. He mentioned this when I was watching him on some stream, and he basically said, well, there are people that are attracted to that, right? So a lot of times high risk is paired with high reward. So if you have these, top people in DeFi saying, hey, this is super risky, chances are you're going to lose all your money. Well, high risk is high reward. I kind of want that high reward. So maybe I should look into this, or maybe I should put my money into this, because if he's saying it's a high reward, high risk, it's probably high reward. So how do we, kind of meet in the middle there? I mean, we don't want to be warning people only to encourage them. But then at the same time, we don't want to just say, hey, let's not warn people at all. Screw it. It's not working. I think it's education, really. We need people to make their own decisions. And I think that's where a lot of people are going. As far as warning people, they understand that, saying, hey, this is super risky isn't just going to stop people from doing it, right? It might stop some, but really, like, what I think a lot of people want people to do is go out, do the research yourself, obviously, do the diligence, look into this stuff. And this is very hard with crypto. This is something that I'm very often pushing beyond just DeFi risk, is education. Education is so important in crypto, in DeFi, anything to do with Ethereum, blockchain, because it's so hard to navigate a lot of this stuff that anyone who isn't a tech native, grown up around a computer, it's like this stuff is navigating like a minefield, basically. You have people out there who can barely manage to log into their Facebook. How are they going to manage, MetaMask and Words and all these different protocols? And so it's very important that people stay educated and, have the right resources to learn about these in an easy way. That way they can make their own decision. Is this risk really worth it? And how do I, measure this risk? Which goes to the next point. How do we measure this risk? So with DeFi, risk is kind of evolving. There's always new risks kind of coming into play. And it's very hard to like give an exact outline of, how do we measure it? So I guess I'm going to share like a couple of things that I personally do to measure the risk in DeFi. And one is audits. Now, this is something that, is screamed everywhere, is audits, audit this, audit that. If you don't know what an audit is, basically you get people that know or are good at reviewing code, securing it, making sure it's safe, I guess. There are companies that specialize in this. Code producers or developers would send off their code. These people would review it basically and say, hey, we found an exploit here that needs to get fixed. Or they could say, hey, yeah, we looked over this. It looks great. Your audit is perfect. Here you go. So the more audits that are done, it's never a sure sign that, nothing bad can happen just because an audit is done. But it is more of like, it's just an extra sign, I guess, that it's going to be maybe most likely a little more safe. again, maybe it still, an audit does not mean it will be safe, but it's just something to look out for. It's better if they do have an audit than don't. Then we have admin keys. And this is one of the things that Chris Black from the community, he kind of brought a lot of attention to this, where prior not a lot of people were focusing on this. And I actually like a lot of respect to him for doing so, because I think it's almost like after he made the video about admin keys and started yelling about it, everyone kind of paid more attention to crypto risks, or risks in DeFi, I guess. I don't want to discredit, Taylor Monahan. She also has done, awesome work in yelling the risks about DeFi publicly. But basically what admin keys are, I kind of explained it earlier, I guess, but it's like the master key to a contract. So different contracts have different admin keys or no admin keys at all. But a lot of times, like, these admin keys can pretty much, play God with these contracts if they wanted to. And one example is like the recent sushi farming. So they have an admin key. And at first, someone posted on Twitter like, hey, this admin key could steal all the liquidity, what's going on? Like, shouldn't we be freaking out? And then, the people come on and they're like, well, no, it's in a 2-day time lock. So, if anything wanted to be done, they would have to sign it, and then they'd have to wait 2 days before anything can be processed. Well, I mean, it's good that, we'd have to wait 2 days. So there's a chance that, we could probably just pull our money out, which is fine. But at the same time, it's like DeFi isn't really DeFi when, something can, I guess, like, be destroyed in 2 days, or like, be completely ruined in 2 days, or controlled, I guess. So it is a start. And I know a lot of these projects, like, they do want to move away from admin keys in the future. So I'm hoping that it comes to that. But it's like going from admin keys to say, hey, we now have a 1 day or a 2 day time lock. That's an improvement, but it's not really, removing the risk entirely. So we'll see where that goes. Allocation is another one too. If you have like a governance token, obviously I always look into, how much is the VC being allocated, how much is going to the team, to the developers, if there's any like pre-sale, things like that. You always want to make sure, because is it really a governance token if 50% is owned by one party? Then the team too, always kind of look into their background and any credentials they have. A lot of times people would look down upon anonymous teams, and I think, they still do, and it's still right to do in some cases. But recently there has been like an increase of people that are, I guess, advocating for anonymous teams. It's more like the crypto feel, I guess, a bunch of anons working on something, I guess. But regardless, just check out the team, always look into their background, see if they look reputable, or if, there's any red flags or sketchy things. I mean, those are some of the things that I use. Let me just see if there's anything else. No, but then I do have noted, like, there are additional risks too that you really just can't always measure it. Like, you just gotta, it depends mostly on the project. Like, as an example, this yam thing, I had some yams farmed, and then they had a migration from the first yam to like the new currency yam. And I had like 2 days to move my yams over, and I was like, okay, I'll have enough time. Well, I just forgot. It wasn't a big deal. It wasn't a whole lot. But now my yams, they're useless. They're stuck on the first one. There's no way I can ever get them back. So it's like, that's a risk too. Like, you have to be active in the community at that time, which most people were. Like, I'm not trying to blame Yam at all for this. Like, it had to be done. But this is something that, like, your regular average Joe, he's not going to be sitting on a Yam Discord or Telegram all day to prepare for that. So it's just like little risks like that you always, got to be prepared for, watch out for, that you might not ever know how to even measure until they happen. So I messed up the title here, but what does DeFi and its risk look like in the future? So in the future, I expect to see more insurance options like Nexus Mutual. They allow you to like insure, say you have a vault open on MakerDAO or Aave, things like that. You can actually open up an insurance position on it just in case, say, there was a smart contract exploit. So you're kind of like mitigating some of that risk, kind of removing it, which is always good if you're a little worried, since all of this is very experimental. I also plan on seeing more auditing options in like companies. It would be nice to see. Right now, auditing firms are like weeks and weeks backed up. They've got so much to do. The pricing is so high just because, there's so much demand for audits, but there's not enough people doing audits. So definitely it would be nice to see more, auditing firms, less vegetables, more innovative long-term projects. Some of these things are really cool. The whole Wi-Fi thing, YAM even, like I do like all these experiments personally. I think they're great, but it's not sustainable to release a new vegetable every week. I do think in the future, we're going to start seeing obviously more innovative long-term projects that could even learn from some of these experiments, maybe take some of the cool, important stuff. I'm going to wrap up here real quick. I think I'm definitely running out of time. Do want to see more test nets being used. That would be nice. People should be using them more. And then more docs and education. Again, huge. Education is absolutely huge. I wish more people were doing it. People that aren't in crypto, they're kind of like it's a hobby. But if they want to learn, they want something to do to help out in crypto, education, seriously, look into it. Whether you write something, a blog post, make a quick YouTube video, anything, it's very helpful. Education is very important. So thank you, everyone. I'm DeFi Dude. You can follow me on Twitter. Follow us on Aave. Our governance progress, lots to come there. So thank you, anyone.
Thank you. So I think that was a really, really important sharing. I think a lot of us are going into DeFi right now, and we all should be made aware of the risk. And this is the reason why we organized this event, right? We want you guys to go into DeFi with your eyes open. So last but not least, we have our co-organizer, Lisa Tan from Token Economics. She's also the lead token economist of Token Economics. If you want to go into DeFi, it's all about tokens design and systems. So if you don't know anything about that, be sure to take notes, and you can also, sign up for, Token Economics classes on her website. We'll put it up next, and we'll put it up below, and we'll bring her on right now. All right, Lisa should be coming online in about 5 seconds. Thanks, guys, for staying on so far. We are about to reach the end, and it's been a very, very interesting night. Thank you for all of your participation. We see a lot of great questions coming up. We'll make sure that we put this online for those that had to run off for a while for toilet break.
You hear me? Yes, I hear me. You see the screen? All right, I'm just going to check one time if you guys hear me. All right, seems like all good to go. Okay, so thank you so much for staying for so long. This is the last part, and I think this is probably the most important part. Then again, I'm biased because it's my part, right? So something that the DeFi space is on about a lot is DeFi a Ponzi scam? Because there's a lot of pumps and dumps. Everything on Twitter is about shilling all these different projects, and like all the risks that DeFi Dude was saying just now, there are a lot of risks involved, and there isn't proper audits that's being done. So a lot of people are wondering if this is a scam. if you look at the questions that is on the chat as well, you can see that a lot of people are asking if this is a scam or is it Ponzi. So here is why I'm here to tell you that DeFi is a lot more than just a Ponzi scam. So we'll cover 3 things today, and I think I'll cover it a bit faster so that you can ask more questions. But I'll cover why DeFi feels like a Ponzi, and which is why some sentiments is that it's very risky, it's very Ponzi-like, I don't want to join DeFi. The second is why DeFi is not a Ponzi scam. And thirdly is the future of DeFi moving forward. So when I'm talking about DeFi here, I'm talking about the general ecosystem, not just a specific project, because the ecosystem in general is doing good. But like every other systems in the world, you have a lot of scams going on. Like even the traditional financial market, there's a lot of scams going on, but you can't discredit the entire system. So DeFi is a new system, it's a new sector, it's a new industry. And so there are some scams coming up, but you can't use that to define the entire ecosystem. The entire ecosystem is doing some good things. So let's get started. If you just Google DeFi and Ponzi, you see lots of weird articles saying that, is DeFi another name for Ponzi? DeFi is basically ICO 2.0, where people are pumping and dumping, and how DeFi is all very, it's all fluff and just scams. And if you go online, you see that on Twitter, everything is just memes. So with all these memes and with all these, jokes going around, it's like, is this even serious? And why should I join? And how is this a legit thing? And how are people getting money? How is it, 100% returns, annualized returns? Because where's the money coming from? Where are all these yields coming from? Is it just people swapping tokens with each other or people trading with each other? But it's just within the circle, within this little pyramid scheme. So if you look at the mechanisms that we have today, and all the 4 other speakers have talked about it, we have things like liquidity mining. You have it on Uniswap, on synthetics. You have yield farming. You have compound. You have ham. You have spaghetti. You have pasta. You have sushi. You have a lot of these kind of different projects and different mechanisms. And it does feel quite like a Ponzi because it feels like the initial people who are in the space are these VCs. So as a protocol or as a project, you need some funds before you get started because you need to hire developers, you need to hire engineers. And where do you get the funds from? Usually you go to the VCs. So the VCs will be giving you some funds, and in exchange, they will keep your tokens. Once the protocol is ready to be used, then you have this whole liquidity mining thing. And this is also where the lockup period is done. And these VCs can be putting their tokens out on the secondary market to be selling. So it's kind of like a dump. So that's what a lot of people are feeling, especially during the Amperforth. One of the other tokens is Amperforth. That's something that happened a couple of weeks ago, and there was huge volatility in prices. So people feel that, this is it's kind of like cheating, because the whole thing about decentralized finance is that no one gets to hold a lot of power. You want to reduce the risk of whales being involved so that you have more equitable distribution to all the different holders in the space. You don't have one person holding 50% and everyone else holding a smaller percent. So that's not fair. So there are some sentiments like this saying that it's just a scam, or when the initial distribution is not fair enough, or when people have too much power, because we talk a lot about governance tokens, and governance tokens inherently have some power and some say in how the protocol or this application will be moving forward. So these are some worries that are involved. And if you look at the prices of these tokens, they're also going up like crazy. So this is the Yearn Finance. Everyone has talked about Yearn Finance. Great project, great guy, great developer. And you can see that the prices actually started from zero. So in fact, the developer that created it said that the token has zero value, zero financial value, zero monetary value. It has some economical value because it is a governance token of some sort in the ecosystem, but real financial value, nothing can justify it. So he did say that he did say that. It was like a disclaimer. So prices started at zero, and then now it's way more than Bitcoin prices, and it hit like $44,000 yesterday for one token from zero, and this was just like a month ago. So the prices are soaring like crazy. People are shilling these tokens like crazy, and everything seems to go out of hand, which feels kind of like a Ponzi scam, right? So it feels like a Ponzi scam, but is it a Ponzi scam? The thing is, that's not true, because if you look at it, a Ponzi scam is where if you look at a distribution of all the economic value, all the value in an ecosystem as a pie, and a Ponzi scam is where you are extracting the value when someone else is coming in. So that means the pie doesn't change much I'm only earning interest, or I'm only earning money because some sucker is coming in and I'm taking his money. And that sucker will take another sucker's money that just came into the system. So that is where the pie is stagnant. But the thing about DeFi is that the pie keeps growing. There are more projects being built. There are more protocols being built. Just maybe the beginning of the year, there were only a couple of projects around, testing and trying out these various lending protocols, these various portfolio asset management protocols, these decentralized exchange protocols. It was a lot of testing, a lot of trying. And they don't try to capitalize the entire financial market, because finance is a big field, right? You've got your leverage, you have your brokerage, you have a lot of different fields. So with DeFi, every protocol is trying to specialize on a small little aspect. And then they kind of like little Lego blocks. Then you just put the Lego blocks together to create some form of interesting empire or interesting building. So this is what compostability that Sebastian said just now, where all these protocols can interact with each other. And because they get to interact with each other, this is where the pie grows. So if you think of the pie example again, we're going to make a pie, and we're going to need a lot of ingredients. We have the filling, we have the flour, the egg, the sugar, the salt, and all of these little protocols, like the lending protocol is bringing in the filling. The leverage protocol is bringing in the salt. The derivatives protocol is bringing in some sugar. And together, we come together to build the pie and to keep growing the pie. And this is why it's so interesting and it's so exciting. And that's just on the protocol side. The thing is, with all of these protocols, with all of these little ecosystem and applications, you're building your own community of people. And these communities can only grow when they interact with each other. The thing about platforms is that the platforms are pretty neutral because they're just technology, right? The value add comes from connecting the buyers and the sellers. So if you look at economics, you've got supply and demand. With supply and demand, they only make sense when there's equilibrium, when they interact with each other. So with all these different protocols or different applications, what they're just trying to do is to build in this layer, this playing field, and suppliers and buyers can come in to interact with each other. The more they interact, the more economic value add is created, and the pie just keeps growing. So that's where the pie keeps growing. But the exciting part, I think is super exciting, is the new business models. So if you look at from an economic perspective, because I'm an economist, right? If you look at all the previous business models, it's usually one-sided. So for example, going back to the pie example, I am a baker and I bake pies. And if you want to buy the pies, you come to my bakery and buy the pies. But there's nothing much I can do. I can probably ask some people, as the regulars, do you want to try this new flavor or whatever? But it's still quite a static kind of business model. The supply and demand is still very independent. However, something that you realize recently in the past, 5 to 10 years, is there's a boom in this new business model called platforms. So you've got Amazon, Airbnb, Uber, Deliveroo, Foodpanda, Grab, and all these other projects. They are platform activity or platform business models. That means they just provide the technology and they connect two sides of the ecosystem together to transact. And this is where a lot of economic value is being created. Now, because I'm an economist, one thing that economists are trying to do is how do we quantify this economic value being created, and then we can account for them in our GDP. Because at the end of the day, GDP is the value of what the ecosystem, the country is creating, right? With these values, with these platforms, you can only calculate the value add, the GDP kind of value add with all these transaction fees. But there are a lot of intangible value in creating ecosystems. There are a lot of intangible value or economic value that I like to call them, with connecting two sides of the platforms together, the buyers and the sellers, so that they can transact very, very easily. With the reduction of transaction cost, that's where you can have increase in economic value add. So this is something that economists have been looking on for ages and ages. Until now, we're still researching about them. There are a couple of economists that is just very focused on digital economy and how to account for them in our GDP, in our real GDP. So one thing that I realized in DeFi is that what we're trying to do is with all these native tokens, because we talked about YFI tokens, we talked about compound tokens, we talked about A tokens and Aave, we're actually tokenizing the economic value of this ecosystem into a token. So a token can have a lot of utility, but whatever a token is just a representation of value. So in these ecosystems, tokens are just representing the economic value of this system. And when they are traded in secondary markets, so when I take the YFI tokens and trade it on Uniswap or trade it on Binance or Coinbase or whatever you want, you can get price discovery by the secondary market and have a value to that. So in that way, we are now assigning a monetary value to these economic value that systems are creating, and then we can account for them in the GDP, which I think is just mind-blowing, and it's so exciting. So there's a very, quite a nerdy economic explanation to why this thing is very interesting and very cool. The other interesting part is that we're developing new P2P incentive models. So one thing about the whole decentralized finance or degenerate finance that you want to call it is to remove intermediaries. So instead of having a few people like these top investment banks holding all the power, voting power, and all the equity of the top 500 companies, what we're doing is we're removing them. We're also removing the commercial bank's power to be selling to investors, and we're giving the powers all back to people. So it becomes a P2P investment, a P2P trade. So it's very retail focused. The cool thing about that is that now we have more money to be distributing, right? Instead of giving money to all these intermediaries, because every time like a company gets to IPO, they have to go to a bank. So let's say they go to Deutsche Bank, and Deutsche Bank will be doing whatever things, get a huge sum of money, and then helping this company to be listed on the Dow Jones or whatever stock index that you have. Now, we don't want Deutsche Bank anymore. Now we can do that in decentralized finance. You just list it on Uniswap, you have your liquidity mining and all these kind of incentives in place. So it becomes a very P2P incentive model, and you remove intermediaries. The cool part is that, now we don't have those suckers which are stealing a lot of the money. The bad thing is that now we have a lot of money. How the hell do we do that? How do we distribute that? How do we allocate that? How do we reward the right types of people? And I would say that this will be a thing moving forward, because we realize that capitalism doesn't work so much anymore. Capitalism is not going to be so sustainable in the long run, that we're looking at new forms of capitalism, maybe a social capitalism kind of thing. So we need to have a lot more new P2P incentive models. And where's the best place to test? The best place to test is DeFi, which is what we're all doing right now with liquidity farming, with yield farming, with all these different interesting mining and incentive mechanisms. We're trying out different P2P incentive models. And this is where it's very exciting, because this means a lot to the future of DeFi. Two things. The first one is that what we're seeing in DeFi right now, as you can imagine, is just within the DeFi space, right? Within the crypto space. You don't have that much transactions in the real world, which goes back to my point of the whole GDP accountability, because right now we're just trading nominal value. There isn't much real value being traded unless you exit the crypto space and you transfer your Bitcoin or your compound tokens or YFI into USD and then change it to the USD in your bank. Otherwise, you can't really, it's quite difficult to account for it. So right now, everything is still within the on-chain ecosystem or on-chain sphere. The future of DeFi is to allow all these testing and all these experiments to translate into an off-chain world, because the off-chain world is super inefficient. The financial system is very inefficient. The governance system is super inefficient, as you can imagine. So what we're trying to do now is to run all these little experiments, little tests, to see if this works in an on-chain world. And once it works, you have all these protocols or all these oracles or all these bridges to link them to the off-chain world. And then we can now bridge these two worlds together. And that's super exciting. The other thing is also, now we can better account for all the economic value that is being created from a very small ecosystem perspective. And now we can also translate them to the off-chain world and account for them in a much more equitable way, a much fairer way, so that when it comes to governance, the governance has better resources, better data points to be accounting for all these different changes that's going on in the world. So that is a quick summary of DeFi and Ponzi Scam. And I would say this is not a Ponzi Scam. Some of them could be Ponzi Scams, absolutely. Please do your checks about that. But for those that are not Ponzi Scams, they're really just experiments. Of all the four other speakers have also mentioned that these are just experimental phase. And it's very interesting to just play around with it, to learn how it works, and to explore what kind of social experiments that could be, what kind of capital allocation that could be, what kind of governance systems that could be. Because honestly, I'm going to tell you that there's so much economic literature out there talking about the technical and the academic aspects of all these experiments, but we never really had the chance to explore them. There are a lot of interesting monetary policy mechanisms in academic papers, but we never really get to try them out. I would say that Carbon, Ampleforth, Heaven, these are three, interesting projects. Carbon doesn't exist anymore, or I think it was basis. But there are a lot of more dynamic variables that you can play with in the DeFi space. And now we can actually try out all these experiments that we've been talking about for a very, very long time. In fact, in the academic space, a lot of people are actually taking out all these old papers, all these old research papers, and trying to test them out right now on DeFi. So that is a very, very cool way to be trying and experimenting. And if this works, this could be huge, and this will be huge, and this will absolutely define the future moving forward. So that's a lot of content, but I think it's very important to understand from that perspective as you enter DeFi, because you can look at DeFi as a way to, park your tokens into your portfolio and grow it. Absolutely, do that if you want. But also you're also part of this experiment to test out if this is going to be our future. DeFi Dude talk about more testnets, right? I would say that there's testnets for crypto, and then crypto is the testnet for off-chain. So the on-chain things, everything that we're doing is basically a testnet, and then how it will interact with the off-chain world, how it will react with the off-chain world. Because if you think about it, all the people on the on-chain world is self-selecting. These people are tech-savvy, these people are interested, these people are innovative, these people are disruptors. And so it's easier to play around and explore. But as we move to an off-chain world, you have a greater variety of people. So what kind of incentive mechanisms need to be in place? What kind of social contracts are we going to consider? What kind of a monetary policy we need to consider? What are all these other, agent-based modeling that we have to consider when we are modeling our ecosystem? So that's absolutely super fascinating. And this is right now one of the best times to be. And do check out all the different YouTube channels out there, all the Twitter accounts out there. And this is my YouTube channel. I do weekly podcasts on some nerdy stuff. But I think it's very important to understand, not just from an investment perspective, but also from an education perspective. Because if you don't educate yourself, the space is moving so fast. 1 hour in DeFi, it's like 7 years in the real world. So as long as you miss 1 hour, you're lagging way behind. The industry, the innovation is moving crazy fast. So it's important to get educated. And not just get educated for investment purpose, but get educated because this will start changing the world, and this will be defining what the future is going to be like. Yes. If you have any. Whoa. All right.
Thank you, Lisa. So guys, thanks. We've come to the end of the webinar. We're super, super thankful and happy that all of you guys came and attended and stayed the whole way and learned about DeFi with us. I think all of the speakers today has a lot to share, and there's a lot that we can learn from them. Q&A, we'll make sure that we reach out to the speakers to answer the Q&A. They'll probably be putting it out on their Twitter. Otherwise, we'll put it on our website. You guys have your ways of reaching out to them. I think Lisa does a pretty good topic on, the good, bad, and ugly. I think it was episode 15 of a podcast. I can't really remember, but it's been a long webinar, and we want to let all of you guys go off. So before we go off, just take note that all of tonight's sharing will be made available on our YouTube, on our website, on Economics Design's YouTube. And we are coming back to you in 2 weeks on 14th September. And we'll be talking about DeFi again. This time around, we'll be bringing some really exciting projects, some of the best projects in the space, some of the projects that you need to absolutely get into to do well in DeFi. And we'll have a surprise for you too. So thank you everyone. This event was brought to you by Grounded, and I'm Zelwyn, the host for tonight. Thanks everyone. Bye bye.